I do expect that, in 2026, we'll be back into the six figures. I mean, anything can happen between now and year end. And whether it's 2026 or 2027, I think we'll be seeing new all-time highs, most likely. Um, and it's funny when because I watch Twitter sentiment, when Bitcoin is absolutely soaring, I get sometimes dunked on by Bitcoiners saying, "Why do you own any gold? Why do you own any stocks? Why aren't you 100% Bitcoin?" And it's like, well, because I like some degree of diversification here. And then when Bitcoin's crashing, I get the gold bugs coming out and saying, "Oh, like, they should just own all gold." Or like, "Why do you own any Bitcoin at all?" And it's like funny how that emotional trend goes. And one of the ways is to say, okay, well, you don't want to diversify so that you own a little bit of everything. You still want to have opinions on assets, and you can make concentrated bets.
The market always finds a way to keep people emotionally off balance. One week, Bitcoin's climbing and everyone's a genius. Next, it dips, and suddenly, those same people pretend they never believed in it. But zoom out, and the story gets clearer. With halving on the horizon, monetary policy tightening and loosening like a yo-yo, and institutional flows slowly building in the background, the foundation for Bitcoin's next move is already being poured. The noise might be loud, but the structure beneath it is quietly forming a bullish case. Lyn Alden doesn't trade hopium. She reads the map. In her view, Bitcoin pushing into six-figure territory by 2026 isn't just possible, it's likely, barring any major black swan event. What's more telling is how both Bitcoin maximalists and gold purists come after her depending on which way the wind blows. When Bitcoin rallies, she's asked why she owns anything else. When it falls, they wonder why she owns Bitcoin at all. The irony isn't lost on her. That's the emotional pendulum of the market. People want certainty in an uncertain system. But Alden reminds us that intelligent positioning isn't about being 100% right. It's about being directionally aligned, rational, and patient enough to stay the course. Let's watch more clips from Lyn Alden's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
I think it's actually the more interesting factor is why it's been flat for so long, because the crash itself, like even in the 2017 bull run, that was a fairly smooth and kind of parabolic bull run, but it still had multiple sharp 30% corrections along the way, like several.
Yeah.
And it would just have these V corrections and shoot back up. So it's not necessarily that this one's had really big magnitude. I mean, we touched like 75K back in April, for example. It's not really the size of the corrections. It's more of the length of time of lasting in the state. So the fact that we were 100K in November of last year, and we're, after a year, we're basically flat, and now we're down to some extent. That's, I think, the more noteworthy item. So I don't really view Bitcoin as crashing. I view it as basically stagnating at this time. I think that's the more noteworthy event. There's a lot of factors that can go into that. I think that liquidity is a factor. So we do have tighter liquidity now. But when you look at kind of broader measures of liquidity, they're really not that bad. And I don't expect them to get that bad. I think we're kind of in the bottoming phase for domestic base liquidity at the current time, and broader liquidity is mostly fine. So I think that liquidity is doing it no favors this particular month. I think there's a broader issue. It's AI potentially sucking some kind of capital enthusiasm away from Bitcoin as kind of the fastest horse narrative. Obviously, gold has had a really good year. And then there's also, to some extent, the disillusionment with the other catalysts for Bitcoin. And so, for example, one of the most popular questions I got on Bitcoin podcasts in early this year was, what do you think about a sovereign Bitcoin reserve? And I found that the most boring question. I mean, people had to ask it, but I found it, and I even said it a couple of times, that it was like the most boring question because one, as far as kind of the ethos of Bitcoin, I find the decentralized aspects way more interesting than what is a nation state going to do with it. And two, I'd said I'd rather kind of have a price estimate that doesn't include, Uncle Sam buying 500,000 coins. I'd rather be surprised at the upside if that does happen than to factor that all in and then be surprised when it doesn't. Because my view at the time was that, sure, they're going to ring fence the coins they already have, that they don't owe back to someone else. But that any accumulation from there, I think, would probably be marginal at best. And I'd be happy to be proven wrong, but that was kind of my base case, and I would just plan for that. I think a decent chunk of Bitcoiners were kind of really bullish on that outcome, really bullish on a lot of things. And then when those expectations don't really align, even though it's otherwise a pretty good environment for Bitcoin, especially looking over 2, 3 years rather than just the 12-month period, you start to get deflated expectations. And then lastly, because it's had this pretty small sample size of this 4-year cycle behavior. So it peaked in quarter four 2021, it peaked in quarter four 2017. There are a lot of people saying, well, it's probably going to peak here in quarter four of 2025, and therefore they sell it preemptively and kind of create a self-fulfilling prophecy. I think that the halving cycles no longer are particularly relevant. I don't think even last cycle they were particularly relevant. I think they happen to correlate with the liquidity cycle. I think they certainly were relevant. The first, say, three halvings periods, I think were pretty relevant. I think they've diminished to the point where it's no longer a factor I particularly concern myself with at all. It's more about those other factors. And so I think there's a bunch of disillusionment that's being kind of washed out. And you can have an asset that is a good asset that's sometimes held for the wrong reasons. And so I think the coins are kind of rotating away from people that held for the wrong reasons or the wrong expectations, and back toward the hands of those that have I think, more conservative expectations, while still, of course, being bullish, which is why they hold it in the first place. So far in every major bull cycle, there has been distribution from longer term holders. That's true for kind of any emerging asset. So if you have a startup company that at first starts with like three co-founders, and then it's got a few dozen early employees, and then it's got hundreds, and then it goes public, and then it trades public for a long time, and you get that distribution by people that either want to rebalance or want to upgrade their lifestyles, that have been holding for 5, 10 plus years, into the newer buyers. So that part, Bitcoin's going through a similar distribution cycle. It happened in 2013, it happened in 2017, it happened in 2021, and it happened over the past 2 years, really, of this kind of like OGs selling into the strength. What's a little different is, of course, now that it's more integrated with the financial system, it's a little more complex because you have some saying, okay, I can actually own Bitcoin in some of them want a more regulated environment to own it in. They'd rather not have $1 billion on a wallet somewhere. They of course there are more sophisticated ways to hold it with multisig and stuff, but there's some that say I'd rather bring some of it back into the system, even though it might not be the kind of the Bitcoin ethos. You have some of them that funded treasury companies to some extent, some of them converting into ETFs. And so that is generally happening, but that's actually pretty overall, aside from those specific reasons, the overall distribution of older coins is pretty much in line with other bull markets. That's not particularly new. What is new, there's been obviously more selling pressure from 5 to 7 year plus holders. But one thing I point out on Nostr with a post is that there's a higher ratio of people that have held for 5 to 7 years in the cycle. The older Bitcoin gets, the more these kind of older, like cohorts unlock, because 5 to 7 years isn't even that old in Bitcoin terms anymore. So you get people from 2 cycles ago, of course, selling into some of this. So I generally discount that it's uniquely associated with this cycle, even though that is the number one selling pressure. So it's not about new coins and the halving. It's about what price will unlock existing tightly held coins into the market. I think another factor is that while most of the demand has been treasury companies and ETFs, and by extension all of their investors, there's been pretty weak kind of just broad retail demand. The narrative has been elsewhere. And so the combination of pretty concentrated demand side stuff, kind of moderate liquidity situation, and then the ongoing pressure of OGs or semi OGs selling into the strength is giving some weakness. The bullish part, I would say, is that there's no particular reason to believe that there's a 4-year cycle intact. We haven't hit euphoric levels this cycle compared to prior cycles. Therefore, there's less of a reason to expect kind of a major capitulation of sorts. I mean, that's, I guess, famous last words, but basically you hit less euphoric highs. There's kind of less to potentially wash out. And I think as we return to a more pro-liquidity environment, and as some of the coins that were maybe held for the wrong reasons are already kind of evacuated, I think the cycle could go on for longer than people expect, because it's not driven by the halving. It's driven by broader macro and interested in the asset itself. I
Hmm.
think, I mean, a lot of people are either too heavily in treasury companies, too heavily in altcoins, or um, they are too heavily in Bitcoin in the sense that their expectations don't match reality. So, what too heavy in Bitcoin means can, of course, vary depending on the person, but it's either having too much exposure compared to your volatility tolerance,
Yeah.
or holding it because you expect a 10x gain in a very short period of time, even though it's a $2 trillion asset, um, as though it's a prior cycle. And they're rather than holding it as something that maybe you expect to outperform significantly, but not in that explosive time. I think that people kind of get into a mindset where they're owed a bull market,
Hmm.
which no one's owed a bull market. But then, I mean, the emotional kind of roller coaster is pretty palpable. If you watch Twitter, back when, whenever like MicroStrategy is at 3 times MNAV, the whole Twitter feed turns into like, well, I could actually go to 5 times MNAV. It could go to 10 times MNAV. We're going to the moon now, guys. And then as soon as everything rolls over, it's like, oh, the cycle's dead. That's a Ponzi. This whole thing. It's just like the roller coaster is pretty palpable. If you're just like watching it regularly, it's kind of like a cartoon almost. How these kind of roller coasters come and go. It's usually not as good as people expect, and it's usually not as bad as people expect, is often how these things play out.
Bitcoin isn't crashing, it's shedding dead weight. The sideways chop is flushing out hype driven holders, resetting expectations, and rotating coins back into stronger hands. Liquidity isn't terrible, but enthusiasm has shifted elsewhere with AI and gold stealing the spotlight. Long term holders are finally taking profits while retail remains hesitant. This isn't the end of a cycle, it's a recalibration. Without euphoric highs, there's less room for catastrophic lows. What comes next might not be explosive, but could be more sustainable than people expect. On the other hand, gold is having its moment, retail is catching on, and Bitcoin is stuck between narratives. While liquidity isn't the issue, market energy has drifted elsewhere toward AI, safe havens, and away from riskier bets. Bitcoin's problem isn't fundamentals, it's confusion. Too many bought in for the hype or wrong reasons. The broader crypto space feels exhausted. Without a fresh spark, Bitcoin must decouple from that drag. The future isn't dead, it's just waiting for stronger hands and a clearer story to lead the way. Let's watch more clips from the interview.
Like I mentioned before, we've been in an unusually long period of kind of like flat yield curve, PMIs, like purchasing managers indices of like manufacturing and other signs that are just kind of like in stagnation. Um, Outside of AI, the stock market is pretty flattish, kind of consolidating. And so it's not a very risk-on environment, even though liquidity is good. So when you have kind of pretty decent liquidity up until maybe very recently, and then you have kind of stagnating broader economy, the Fed still trying to tighten things where it can. The things that have taken off has been AI, gold, like kind of what the market ironically looks as low risk. They view AI as low risk, even though there are pockets of it that are obviously not, but they view it as low risk because they view it as like a sure thing. It's like,
Hmm.
okay, that's cycle resistant. Let's go to AI. Then they say gold, okay, that's low risk. Bitcoin, until pretty recently, was in that bucket where it's benefiting from liquidity, from kind of gradual adoption. But as you have kind of like a flattish environment, Bitcoin cooled off. So I think basically gold's behaving kind of, rationally, just a little bit, these things tend to not be linear. So you tend to overshoot to the upside, then overshoot to the downside, then overshoot to the upside. So this did overshoot to the upside faster than I would have thought, but I think it's a gradual realignment for things we've talked about in prior podcasts, a more multipolar world, less kind of a focus on every country just holding one country's bonds as the reserve asset and saying, okay, we'll hold those, but we also want to hold these other, say, 3 things. We want to hold gold. Maybe we want to hold another trading partner's currency around the margins. Smaller ones might say, well, let's look at Bitcoin a little bit. You get that kind of gradual broadening of assets that are viewed as kind of reserve assets. And gold, as the incumbent, is kind of been the chief beneficiary when we're talking about the market's being increasingly spooked about these tens of trillions of dollars of sovereign debt. So whether it's the US, it's Europe, it's elsewhere, the market is kind of long term says, okay, what's the end game here? And you have gold, which is a much smaller market despite being huge than those sovereign bonds. It only takes a small gradual spillover for investors to start kind of going into gold. They don't have to do a ton of research because they know what gold is. So the short answer is it hasn't surprised me because so back when gold was like 3,000, one of the interesting things at the time was that it was not retail driving it. So when you looked at like interest in gold ETFs or interest in physical coinage, it was kind of lukewarm, whereas the price was going up anyway, and it was because sovereigns and institutions were driving it. It
Hmm.
was kind of like gold's moment of like the treasury company thing, right? It's like big pools were interested in it. China and India were interested, so their retail was interested, but kind of the Western retail was like other things are going on. When the Mag 7 was soaring, no one's like they're like, yeah, gold's okay, but I'm not really interested in it. It's only really in kind of the second half of this year where Western retail did start to FOMO into gold. So that's kind of a later stage portion of it. So first institutional, then retail, and that's generally how things go. So if anything, if you'd asked me last year, I'm surprised there's not a little bit more retail FOMO than there is right now. But then I would also not have guessed you gotten to 4,000. But when you do get to 4,000, I'm not surprised that yeah, you start seeing lines outside of gold stores, either to buy it or sell it, because actually both tends to happen. There are people that need money and have a gold ring, and they want to go sell it, and there are other people that are then FOMOing into it. Is how these things tend to go. Um, and if you Bitcoin can have a cycle like that, where if you break the 4-year cycle, you have an up year, institutions are positioned and it starts to rip, you can bring in retail. So it's like just because retail's not here now doesn't mean they can't come later. And unfortunately, retail tends to be kind of the later phase of a given bull run. Now, but I think I view gold in a similar way that I would view AI, which is that it can get into a local bubble, but that I still think it's structurally fine. The last time I gave a warning of that sort was back in 2020. Gold, of course, had a very big moment. And I was like, I could see it taking a breather here. It took a little longer breather than I thought, but then it did this whole kind of next doubling that it did. Um, and I view it kind of similarly, which is sure it's over its skis right now. But I don't view it as like structurally overvalued. If anything, it's going from being just kind of structurally undervalued to like back closer to like what I think makes sense. And so, yeah, I just view gold and Bitcoin as kind of two different assets. Gold still, because it's the incumbent, it has more of a risk-off aspect to it. It's got more of a sovereign interest in it. Whereas Bitcoin is still kind of collectively lumped into a tech play, even though from those that deeply understand it, it does have, digital gold, digital cash attributes that can be viewed as risk off as well. Just the price action tends to correlate more with a risk on type asset. Quite structurally bullish on Bitcoin, for example. But that's also why I own gold and I own equities that have nothing to do with Bitcoin, because there are different size markets, different performance kind of patterns that they go through. And then for me, it's not just about owning what I think is going to be the fastest horse. It's okay, I'll put extra on the fastest horse, but I want to own a handful of horses.
Hmm.
And so when you structure a portfolio like this, it's like, well, okay, I'm disappointed in Bitcoin this year, um, but I'm enthused by what gold did. Um, and if you structure a portfolio that way, you take the edge off for a lot of these things. And so, I think we'll see a rotation at some point. Where I'll be disappointed in the gold side of my portfolio, and I'll be enthused about the Bitcoin side, and then probably it'll repeat again. So, yeah, nothing's really changed around my view of any of these assets. It's just they catch on at different speeds and they have different correlations. And like I said before, I think that a year ago or 6 months ago, some percentage of people bought Bitcoin for maybe the wrong reason. That
Hmm.
they bought it because they think Uncle Sam's going to buy it, rather than buying it for its own qualities and kind of the longer term story of what it is and what it changes. In addition, I think the broader crypto space is basically out of narratives, um, and that's basically dead weight now. So other than Bitcoin and stablecoins, a couple small tech rails to run that kind of stuff. At a macro scale, there's really no there in the broader crypto space. And so I think that that's part of why kind of the whole space is bearish, is a lot of people that own Bitcoin own other assets, and they view it as not just a bad cycle, but that there's just what's the next narrative. You had ICOs, you had NFTs, you had DeFi, you had meme coins, which is basically the most cynical narrative, is saying that we're just flat out saying there's no there. Then even that kind of eventually rolls over, and there's really no kind of you can always be surprised by another one kind of coming out of the hat, but I think a lot of that has kind of tested almost every directional narrative that it could, um, and is kind of set for structural stagnation. So Bitcoin has to kind of decouple from that dead weight to the extent that it's going to keep kind of reaching higher highs.
Bitcoin's recent drop to $90,000 may feel like a gut punch, but the broader context reveals a different story. What looks like a collapse is more of a psychological washout, one that resets overheated expectations and redistributes coins into steadier hands. Swissblock and Glassnode data confirm this. Short-term holders are underwater, yet not capitulating. Long-term holders are selling, but not out of panic. They're rotating, rebalancing after years of holding through cycles and profits. This echoes what Lyn Alden has been warning about. Bitcoin isn't broken, it is misunderstood. Market fatigue, misplaced narratives, and unrealistic timelines have weighed on sentiment. Some investors expected sovereign wealth funds to bid up the price. Others assumed previous cycles would repeat like clockwork. When that didn't happen, they bailed. Meanwhile, capital is chasing AI and gold, assets that feel safer in this tepid, risk-off environment. But Bitcoin still holds its long-term thesis: scarce, decentralized, and increasingly liquid. The key insight here is that Bitcoin's current struggle isn't just about charts and headlines. It is about expectations outpacing reality. As short-term pain clears out speculative froth, strong hands are quietly accumulating. Exchange outflows, stabilizing support at $89,800, and the lack of full-blown panic all point to a bottoming process, not a breakdown. The next leg up will not be driven by hype. It will come from conviction, tempered, patient, and rooted in fundamentals. That is the real silver lining. As we wrap up, are you leaning more into Bitcoin, gold, or something else? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.